Welcome to Premium Cashflow Real Estate Investing Podcast with SK039. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK039, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK039.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Jonathan Twombly with Two Bridges Asset Management Company. Welcome to the show, Jonathan.
Thank you. Thanks very much for having me.
Sure. Jonathan is a very well-known personality within the multifamily industry, so it is a mutual pleasure to welcome you. Jonathan has been doing multifamily syndications for quite some time now. He has studied law. He is a former board member with Harvard Real Estate Organization and a past president with EO, the Brooklyn chapter. And he has his own coaching program as well called Multifamily Launchpad with several successful students through it. And more importantly, Jonathan has very realistic, practical views that I have always enjoyed. So we are looking forward to get into that conversation today. So welcome to the show, Jonathan. Kindly give us a background as to how you got started, what motivated you to come into real estate, and just give us an overview of that.
Sure. I started out as a lawyer. I was practicing commercial litigation on sort of big New York law firms and a bit in Boston and London as well. And towards the end of my career, I was focused on hotel-related litigation. So I was representing a lot of hotel owners in disputes with the hotel chains that flag the hotels. I had been interested in real estate for quite some time, and I was increasingly unhappy with being a lawyer. It was a real grind, especially working in New York, and just found that I wasn't so interested in it over time. I was looking to get into something where I had more control over my life and more control over the business too, and being able to choose how I spent my time. So when the great financial crisis hit, we were actually expecting a big flood of litigation because that's what had happened during the dot-com collapse. And instead, things were so bad that there wasn't very much litigation. So I was kind of sitting around for a while with nothing to do at my firm while we were waiting for this big flood of litigation to come in, which never hit. Sure. And finally, after a couple of years, the firm decided that, they just didn't want to pay me to sit around anymore. So I lost my job, but I was really done with law. I didn't have the stomach to go try to get another law job. I was fortunate enough to have some money saved up and decided that I was going to go and figure out something else to do with my life. And since I had an interest in real estate, I started talking to a lot of people in real estate. To make a long story very short, I connected with somebody who was trying to start up an investment business. And as it turned out, a syndication business. I had no idea what syndications were. When we first started, I was so naive. I thought that we were going to be investing in, like brownstones in Brooklyn, because that's just what my frame of reference was. Sure. And she said, "Oh, no, we're going to go buy 100-unit properties in, Louisiana and Texas." And I was like, what? It was totally like my mind was really blown. That like we could do this. This is something you could do. But once I kind of figured out how the whole process worked, I learned the business from working with her. It ultimately didn't work out between us. We had some differences of opinion over, just how things were supposed to go. So we decided that we would part. And one of the people who had said that he was going to invest with me said, "Hey, why don't we join up together? I'll just be a passive investor in your business." And that was how I was able to start this company, Two Bridges Asset Management. It took us a while to get any traction because I'm sure, as you know, when you first break into the business, especially if you're looking for 100-unit deals, and you're operating, you're dealing with like the real commercial brokers,
Sure.
it's very, very difficult to get them to take you seriously, even if you have financial backing, right? Just because you're not a known quantity. Obviously, it helps to be able to come up with, say proof of funds if you're asked.
Right.
But even then, you get a lot of, I think there's kind of like a testing period where they're going to just send you junk to see if you bite, because they're hoping that maybe, you don't know what you're doing. So therefore you might bite at one of these deals that nobody else wanted. Right. And you have to kind of make your way through that process. So that took it took about a year to kind of like make my way through that until finally we're able to get a deal under contract in late 2013. And that deal was a 100 unit property in outside of Spartanburg, South Carolina.
I see.
And it was a C property. We were very fortunate because I had a meeting with a broker. I was able to get into a meeting with a broker, came through a personal introduction. The broker showed us a deal that had literally just come in the door like the day before. They hadn't even had a chance to really put together any kind of package for it. So it was effectively an off-market deal. I went right out, looked at it, said, okay, this looks decent. I want to make a bid. We came in with a bid and the brokers convinced the seller to take it, and we were off to the races. So that was not the first deal I ever had under contract. With my previous partner, we'd had a couple under contract. We weren't able to close it. We had the money. Money was raised, it was in the bank, but we weren't able to close the deals because we ran into issues with lenders. We ran into issues in due diligence. It was just,
host of factors there.
A host of factors. It was a real learning experience. It was very painful and suffered out of pocket additionally, but it was a very good education in how these things work. So, finally with this third deal that I had under contract, that I was able to close, that kind of opened, I don't want to say the floodgates, but that established me in that market. And then after that, I started seeing a lot of deal flow, and the brokers starting to come and pay attention to who I was and that sort of thing. So that's kind of how I got started in the business.
Awesome. Thank you for that extensive background and the detail there, Jonathan, where you said that once you started, you had some false starts, stop and go, and then obviously you changed and you went with another partner, and eventually I think third or fourth deal that finally came to fruition, and that's the real practical stuff that I like hearing. Sometimes you hear from a lot of gurus type people that, oh, boom, it just happened. It really is a lot of work and things like that, right? So explain us, Jonathan, that you closed this deal in Spartanburg, South Carolina, right? How did you sort of, went into that market, you living in New York, right? Explain us like some of the thought process or the thesis beyond, like why that market or why not something else,
Yeah. So when even before my first partner and I broke up, we had already made a decision that we wanted to start exploring other markets. Like we wanted to have sort of maybe 3 different hubs that we were focused on. And I like demographics. I like looking at that kind of data. And the timing was really good because the 2010 census data had just been released in 2012. So I started really digging into that data. And what I was really looking for were markets that were growing faster than the overall national average, that were also relatively close to New York City. And if you just applied those 2 characteristics as just a way to winnow down which markets to focus on, the Southeast just jumped off the map. Now I kind of like further winnowed it down because I had some, at this point, some perspective on some markets, which like I knew to be very boomy and busty, and I wanted to avoid those markets. So markets like Florida in a lot of cases. I mean, I know not all of Florida. I know like the Panhandle apparently is different from southern Florida, but
More like the touristy, or let's say
Yeah.
Las Vegas or Orlando's of the world, that kind of thing.
There are some markets that are just very,
ups and downs.
They tend to be very, what's the word?
Cyclic or boom and bust.
Yeah, they're very cyclical, and they're very boomy and busty.
Right.
And so the volatility is very great in those markets. They overbuild. Historically, they'd overbuild and then they would crash. And so I also wanted to avoid those markets. So when I was looking at, looking around, what I noticed was that, there was not much less volatility in the Carolinas, and especially in South Carolina at that time. And Charlotte got hit in the great financial crisis, but really that was because of its exposure to banking. And it was, it hadn't really had such a huge run up during the crisis, and it didn't have like a huge collapse after the crisis. So I felt comfortable with those markets, and also just because their demographics were so good.
I see.
So that was really how I came. And then it really became a matter of like, was looking all over those markets, but finding like the first one that I found that I could do happened to be in Spartanburg. So it wasn't because of anything special about that market other than the demographic story that I liked in that market.
I see. And you also said, Jonathan, there that you had, as soon as the deal came on the market, you're fortunate enough to get sort of the first look of sorts, right?
Yeah.
Was that like, you were working with that broker before, or you have had sort of those broker relationships cultivated over a period?
Well, so that broker relationship came about because of personal introductions, and the timing, the timing of that particular deal was just very fortunate because we had planned this meeting. I flew down from New York for the meeting, and really was intending it just as a like first step, get to know you meeting. But because of the way that I'd come into the meeting, where I came in through, a personal connection, I had, I'd established myself kind of in the business, even though we hadn't closed any deals yet. But I had sort of all of the indicia of being in business when they checked me out, that they took me seriously from the get-go. But as I said, like the meeting was originally intended just to be the first step in developing the relationship. And they said, well, hey, look, we just happen to have this deal that fits exactly what you told us that you were looking for.
Right. The deal accelerated the whole thing, basically.
Yeah. So that was just lucky timing, but they showed us that deal because we had done the groundwork of establishing, beginning the process of establishing the relationship.
I see. And you said it was a C-class deal, Jonathan. Explain us, like, I know C-class for a lot of listeners means a lot of things sometimes, because of, all the different markets that we have. Explain us, like the age, the vintage, what sort of issues perhaps you may have had, because, C-class tends to be, sort of a unique place wherein I think you have to have a bit of a skin to, tackle the issues and make sure, there are like, good performance and things like that. Give us some tidbit about, why C-class, or how did you sort of muddle yourself through the deal?
Well, I started out investing in C-class deals because I thought they were a little more accessible and within reach of what I was doing starting out. They also traded at higher cap rates, and I thought at the time that just would translate into higher returns. So I was a bit naive about things when I got into the business. I really wasn't anticipating the all of the sort of capital issues that come with a C-class property, the tenant issues that come with a C-class property. And we'd actually bought it from a rehabber, so a lot of the work was done on the property. So I didn't really anticipate that there was kind of like the underlying stuff would become problems. So in terms of the vintage of the property, it was a 1970s construction. There were some very nice things about the property. It had very spacious apartments, very high, high ceilings. Like they were. It was nice in that sense, and the location was really good. It was literally at the intersection of two interstates, and there were a ton of jobs in the area. within like a
That was
mile
great.
of that. So it looked like a really good deal from that perspective. Even had two hotels next door to it, which are always,
Wow.
Those are good indicators of like a location. But the what I didn't anticipate was the kind of capital issues that would arise on the property in terms of like water mains breaking and things like that, a rehabber isn't going to get into changing those kinds of things. They're going to do much more kind of surface level changes to the property. And then there were the tenant issues. And this is not, this was like a solid market rate C property. It didn't have crime issues. It wasn't like it was just a, workforce housing, as you call it.
Sure.
But we had tenant collection issues, and so there were lots of problems that emerged with that property over time.
Sure. And I always like that perspective, Jonathan, where, we are discussing about, buying a large multifamily, perhaps, as you said, the C class. And I myself I'm the owner of tons of C class, lots of Section 8. And, we have our own property management and construction company here in Baltimore. And we thoroughly understand some of the issues that come up. But, for our listeners, if you can maybe, give some of the description around, some of these issues that happen, like, it's always a challenge that you take over a multifamily, and especially in a C class, you're absolutely sometimes pulling your hairs as to, what's happening. There are, collection issues, there are property level issues and things like that. Give us sort of that, foray into the first couple of months of pandemonium that perhaps may have happened. And again, I don't know the full story, but I'd love to hear, because I can almost kind of see where you're going with this, is that when you say capital issues, it almost seems that, yes, you have had a bunch of issues, and that caused a strain on capital reserves, or perhaps capex issues as well. Give us some idea about that.
Oh yeah, I mean, this property was, because it was the first one, did a lot of things wrong. So one of the wrong things was not having sufficient reserves on the property, because I was thinking more about the investor returns than anything else. And so I didn't want to raise any more money than I had to, because I was so worried about generating the return. Right. So that was mistake number one. That would have solved a lot of issues if we had more reserves on the property. But the issue that we ran into after, God, there were so many. I mean, this was like a baptism by fire kind of property, because really, like, everything that could have gone wrong went wrong. Some of the things that were within our control, some things that were not within our control, some things that were manager caused that should have been avoided, that, just bad management at first on the property. But we had, I made the mistake of hiring a property management company that didn't have a big footprint in the area. I had developed a relationship with this company when I was looking at deals in Louisiana and Texas, and they had a small presence in South Carolina, but
not in Spartanburg in general as such. Like they
had some properties in Columbia, and they had some in Charlotte, and so they were kind of like nearby, but they weren't really very local. And that, but I thought, well, this is a big company. They can handle these issues. And they were also kind of, they were telling me all the right things. Like, I mean, not the right things. Like, they were sort of, I guess, flattering me as a new owner.
I think sometimes I like to say that people can have good intentions, right? I mean, there's nothing wrong in it, but when it comes to property management and like the sort of the practical things, you gotta have systems, and more importantly, the people and resources on the ground ready to go. And because something happens, you have to be within a very reasonable short time. You have to be able to, do things. And more importantly, I think when you're talking C-class, or if you're doing any upgrades, you have to have that sort of human presence, so to speak, that to, monitor, keep a check on tenants and things like that. There's just lots of things that go around that, I guess.
Yeah. And the problem that happened then was that because they didn't have a good presence on the ground, they weren't able to hire the right people to manage the property. So they wound up installing a manager who had no experience with market rate property. She'd come from a subsidized property background. So she didn't have any idea how to market the property. She wasn't used to having to market because with subsidized housing, it's in such a shortage that they just have a waiting list of people who want to be in the properties. So, so that manager wasn't marketing the property, and we started having, an occupancy problem where we were evicting people. First, it was like a double problem. We weren't collecting rent, and then people were defaulting on their rent, and then we were evicting them, but then we weren't filling it up with new people because she wasn't marketing the property. And, so that became, we quickly, in a market where the occupancy was like 95% across the market, we were down at 88%.
Wow.
And, and starting to get in trouble with the lender. And, I'm on the phone, like with them all the time, like what the hell is going on? And they're like, oh, everything's fine. We got it under control. It took a very, very long time before the management company finally identified what the issue was. So even after getting rid of this property manager, which we did, that identifying the issue with the bad debt was that they had inadvertently, the vendor who set the software for evaluating applicants to the property set the income criteria for subsidized housing rather than market rate housing. So that they set the income criteria 2 times. It's basically rent was 50% of income, right? Rather than 1/3 or less, which is what you should have. So people were coming in marked qualified who couldn't afford the rent. So we quickly ran into a very bad delinquency problem and eviction problem, and then we weren't filling it up, and the manager wasn't even getting out. We had, like I said, a ton of jobs within a mile of this property, and that the manager wasn't even getting out there and like going to those employers and doing the marketing that you're supposed to be doing.
Sure. Just for our viewers, Jonathan, I just want to quickly correct what you said there, or rather clarify, is that basically the mistake happened was because the criteria for tenant evaluation or approval was set to voucher-based tenants, which in turn means that for those of you who don't know, a voucher-based tenant is a person whose rent is paid by the housing agency, part of the rent. So let's say, for example, if your rent is $700, in a hypothetical scenario, $500 of that rent portion would come from the housing agency, and $200 would basically be paid by the tenant. So where in Jonathan's scenario, what he's describing is that if you get a market property, now you're advertising to a market and you're saying that, hey, I'm going to accept the $700 rent, but you're really qualifying other people based on that $200 portion. And that's what I'm reading the mistake happened. So in general, you're qualifying people who should not be even at the property. And then, of course, they come in the property, pay rent for like a month or two, and start defaulting from like 3, 4, 5. And you suddenly have not only a collection problem, you're running into bad debt, courts, eviction. I mean, these things really can drain the cash flow.
And it can snowball very quickly out of control if you're not careful. Yeah. So basically it took a long time to identify that issue. After it was corrected, we were in a very deep hole. It just took us, a long time to dig out of. But then, of course, we had other issues on the property that were cropping up, like since we had all this vacancy, this manager wasn't checking on vacant apartments. And so this is, it's South Carolina. It's hot in the summertime.
It's hot and humid.
Hot and humid. And, nobody was checking on the vacant apartments periodically to make sure to see the condition. We had 3 apartments that were overtaken with black mold because the air conditioning had been shut off or something, and there was a water leak. And then so those apartments had to be completely gutted and taken offline. And then since we didn't have enough reserves, we weren't able to rebuild them. And, very quickly, it took us a long time to like save up the money to do that. I was worried about making an insurance claim because I didn't want my insurance rates to go through the roof. And,
Sure.
So there was that. So basically just sort of got into this very deep hole with the property. And then we started, and this is where the kind of like real C-class stuff starts happening. Then we got into a situation where we were having essentially, like I called it the water main break of the month, right?
Oh.
And so we were having just one after another, the water mains going to the buildings bursting, and because they were old, and
Sure.
including the worst case scenario where they burst under the foundation, and that means you have to
Oh my God.
to break through the slab to get to the water main
Sure.
to replace it, and then relay the slab foundation, and just like horrible
Expensive
expense.
Absolutely.
So every time we felt like we were getting our heads above water, then we would suddenly have a $10,000 expense that would eat up whatever profit we had. And then the final kind of litany of bad news on this property was that we had 2 major fires within a month on the property.
Oh my God.
Both likely caused by tenant, I don't want to say misconduct, but tenant fires tend to be kitchen fires, and both of these fires
were bedroom fires.
They were kitchen fires, but they were. My suspicion is that somebody just went to work with the stove on, and because they both happened around like 8 a.m, and with no tenants around. So but we had 2 major fires within the space of about a month, lost 9 units. That was fortunately all, insured and covered, but now we were just dealing with that issue too. So that was kind of like, I never had to deal with any of these issues on any other property I owned. I dealt with all of them on one property. So in a way it's good, I guess, like, we had that one property sort of over there with the problem. But I'll tell you, I learned so much from that property and dealing with those issues, that it's, I completely reevaluated the way I look at everything, from, on the one hand, from like what kind of property I'm going to target, to the issue of like adequate reserves, to, the issue of,
property management,
leaving property management, also not leaving the property management, like being more, digging a little more into what they're doing and not trusting them as much, just kind of the trust but verify. Like the verify portion has to be, you have to really be on top of that. So it was a great learning. It was a horrible thing to go through, but it was a fantastic learning experience.
No, I think it is very valuable, Jonathan, what you're sharing here is because that very piece of property manager that you said, I mean, it kind of snowballs into so many things, as you alluded to, whether, you're not verifying the tenants right, or you're not collecting properly, or you're being like too lenient on your rules or what have you. And, tenants are taking undue advantage of things and stuff like that. And the classic mistake that, you're not even like sort of opening the doors of your vacant unit for, for however month. I mean, how difficult would that be? But that kind of sort of plays into like, you're probably having a wrong person, or they just don't know what they're doing, or they just like have never experienced that kind of stuff, just inexperience, So Jonathan, taking a page from all of this, right? How are you sort of insulating yourself now? Are you of the opinion that, hey, it's better to go into a higher grade property, or perhaps there's nothing wrong with C-class property, you just have to know the things to do right the next time? What lessons have, or how are you adapting yourself now?
Yeah, I would definitely be more focused on the B-class property going forward. And just to avoid having to deal with those kind of structural systems issues, that are just the B-class property is just not as old, right? I mean, the systems have not been as beat up. Right. And not to say I would never invest in a C-class property again, but I would approach it very differently. I would really want to have much better reserves on the property and invest a lot more upfront in getting after all of the stuff that could go wrong sort of proactively. Now you've always got a balancing act, like, new roofs don't make you any money, right? If you invest in a new roof, it doesn't translate into rent because nobody can see it. Right. But at the same time, you have to maintain the property. So
you're expected to keep all those things up tight.
Yeah, you have to keep them running, right? And you want to, properly, you want to go in with your eyes open. But I think that, unless there's some kind of unusually attractive situation around a C property, like perhaps it's really in a good location and you really can, do a good value add on it to bring it up to a B, and then the systems are in good enough shape that you can reserve a bit of money to deal with what comes up. I think in that situation they could be fine, but I think also the tenant issues are more of a problem, because even if you set my view has changed on C tenants as well, because even if you are adequately vetting them coming in, the C-class tenants are the most vulnerable tenants of all, right? They don't have a lot of resources to fall back on.
Right.
If there is a recession, they're the first to lose their jobs. And they just don't have a lot of cushion, right? And I think that if it comes to, if someone has to make a choice between paying their car payment and paying their rent, they're going to pay their car payment because they need it to get to work. It's more valuable to them. They're going to default on the rent first, and they don't have any resources to collect against, right? If they miss their rent. So I just feel like, particularly in an environment in which people are paying a premium to buy property, that to then kind of set yourself up for when you're pricing in. Now, obviously, we're in a different situation right now with COVID, and we still don't know how that's going to play out. But just looking back to, say, like January of this year, if people were buying C property and they're pricing in all of the good news of the economy into that deal and paying a premium for it, and basically buying based on good news that kind of has to continue, you're just setting yourself up for disaster when you've got a population of, basically you're taking on a population that's the most likely to get hurt if the economy goes bad. So I would want to, just being a conservative investor, want to stay away from those deals, unless I was buying at the bottom of the market and I was buying at a discount, and I knew that I could build in a big margin of safety into the deal, even given who the tenants are and their quality, as their credit quality. I shouldn't say that, not their people quality, but their human quality, but their credit quality. So
sure. No, I agree with you that I think they have so much less savings in that C class that unfortunately, upon a pandemic like COVID, if that hits, or any dip in recession, their savings are gone, and you're pretty much all of your defaults increase, and that's a horrible situation to be in. How was your deal structured, Jonathan? There, like, was it sort of a 70-30 split, or describe how was the deal structured?
We based our syndication model on private equity, so it was a 1-in-20 split, so 1% asset management fee and a 20% of the upside, subject to a preferred return. So we wouldn't participate if the preferred return wasn't met, but it wasn't like a lot of people do, like a split over the return. So they have an 8, whatever preferred return is, and 50-50 above an 8, or whatever the split is. We just structured it to be 80-20 overall, so that the investors get the first 8, then we get 2, and then and then if there's more after that, then it's all 80-20 to the investors.
I see. Now, just to complete the loop on your story there of the C class there, Jonathan, how did that fare out, like, over the long term? Did you sell it, or were the issues resolved after year 2, year 3?
We did. We wound up getting it rebuilt. We did sell it at a substantial profit, and but frankly, that was really because of the way the market moved. I was very happy to exit that property, and especially happy to exit it at a substantial profit. We wound up making really almost basically the entire profit on that property from the sale, and just from cap rate compression. Now, if the property had ever performed where I had expected it to return, we would have made even more money, both along the way in terms of profits, but also just on the price that we would have gotten given those cap rates at the end of the deal. But nevertheless, I was still very, very happy, and my investor, who had completely lost his patience with the deal, was very happy with the end result. But again, like, I can't really take credit for that. It wasn't anything we did. Just the market decided that it was going to, start paying 5 caps for C deals, and that helped us. So
Right. Yeah, I think some of the growing markets sometimes tend to have those definite advantages. Now, Jonathan, turning things a little bit here, you have a coaching program by yourself, right? You've seen a lot of students come and go through your program as well. Give us some sort of foray into how students, or like, young listeners listening out there, explain them that what should be the factors they should be looking at, or what it takes to be successful, like what sort of personality, what sort of habits, or what different things that you have seen students do on a daily basis that propel their success.
Well, one of the things that I have learned kind of the hard way, because I tried to do everything myself, is that no one can do everything themselves, right?
Sure.
And because there are different, and I'm not even just talking about bandwidth, because I think that one of the good things about this business is that you don't have to work 12-hour days to be successful in real estate, right? You don't have to kill yourself. You can definitely handle the work involved, especially if you're not doing the property level management yourself. If you're just asset managing it, it's not a time consuming business.
Right.
But you can't do everything in the sense of, you can't do everything well. And what I mean by that is that there are different personality types that are really needed for different parts of the business. So for raising money, right, that is, typically kind of more of an extroverted kind of, personality that does well in that, someone who likes to be talking to investors and likes to be, out there doing a lot of networking and things like that. That's the personality type that's needed for money raising. But for deal finding, you need somebody who's very analytical, tends to be probably more introverted. They like staring at spreadsheets. They like digging into the numbers. And those two things are not really, it's very rare to find those two skill sets in the same person. Or even if you can, I can do both, but I don't really enjoy both of them and don't think I'm particularly good. I don't actually, even though I have a big social media presence and stuff, I don't really like networking very much. Like I'm not, that's just, I'm more introverted. I like to kind of be by myself, frankly. It's easy for me to be on social media because like I've said before, I'm okay talking with 1,000 people, from a stage, but I'm less comfortable talking to person one-on-one, So, so having a social media platform is great for me, but it doesn't, until I built that, I wasn't very good at the money raising side of things. So one really important piece of advice I have for you, if you're a new investor, is to kind of just be honest with yourself, say, what do I prefer? Would I rather be looking at spreadsheets all day and digging into the numbers, or I'd rather be out there talking to people all day and trying to make connections? And whichever one you decide is fine, but then you should go find someone else to do the other side of it and help you out. And I think that is, if you look around at all of the people who, there's a number of people in the business that I started out with at the same time who grew a lot faster than I did. And part of the reason they did is because they did exactly that. They didn't try to do it all on their own. They found partners to complement them, and they could each then kind of focus on their specific skill set. So that is something that I think is not talked about a lot, but it's really, really important. So build yourself a team. There's a lot of talk about building the team, and what people talk about is like, oh, you're a lawyer and your accountant. Before you even get to that stage, build your internal team, which is like you and the other people you're going to work with.
Sure.
And it doesn't mean you have to go out and form a company with them, but you should have people that you're going to do some deals with and see how it works. And then if you decide that you like working together, then that's the point at which you could say, okay, let's form a partnership now and go into business together.
I totally agree with you, Jonathan, and I think your the group coaching program, the Multifamily Launchpad that you have, is also a great way that to find those like-minded folks, sort of exchange the phone numbers, emails, get on some informal calls and understand, what markets they like, what are their strengths, as you rightfully pointed, it's all about, that informal connection, teamwork, and playing to your strengths. So thank you, Jonathan. Unfortunately, we are out of time, and I appreciate you coming on. Tell our listeners, Jonathan, how they can get in touch with you, and tell us more about some new things that are probably happening around your desk today.
Yeah, sure. If you are interested in talking to me about investing, then the best place to go is to my website. Just Google Two Bridges Asset Management LLC. It'll come right up, and there's an investor page where you can fill out a form, and that'll start the process. If you're interested in learning from me about how to do this, and you're interested in Multifamily Launchpad, go to multifamilylaunchpad.org. There's a free download there, which is the ultimate checklist to doing your first 100+ multifamily unit deal and getting paid to do it. And that is like an 11-page long checklist that tells you every single step of the syndication process. If you download that, you'll get on my email list. I send out emails almost every day talking about multifamily real estate and giving people the opportunity to sign up for Multifamily Launchpad if they're interested. So those are the two best places to reach me.
Awesome. Thank you. It's been a pleasure, Jonathan. And viewers and listeners of the podcast can also head out to premiumcashflow.com. There also we have a lot of news articles, and if you are willing to get on our mailing list, there is a tab for invest with us. You can register yourself. We can get on a short call with you and find out what what are your interests, what are your goals, what you're looking to do, and we can work with you also in future. So thank you, Jonathan. It's been a pleasure.
Thank you very much for having me.
Thank you. And I look forward to having with you again in future as well.
Absolutely. Thank you so much.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.